Hello and welcome to the Baird Trust Large Cap Equity Fourth Quarter Portfolio Recap. My name is John Watkins and I'm a co-portfolio manager on the strategy. This first slide shows our performance track record. In the quarter, our portfolio increased 12.8% gross of fees and 12.5% net of all fees compared to the S&P 500's 11.7% increase. This brought the full year return for our LCE portfolio to 24.9% gross and 23.2% net, compared to the index return of 26.3%. The strong returns in 2023 come after a double-digit decline in 2022 and were surprising to most market participants, which I will touch on later in the portfolio outlook section. Our singular portfolio objective is to outperform the S&P 500 over full market cycles. We invest with a long-term business owner mentality, so we're always focused on multi-year periods rather than any individual year. And now we have a track record that spans 30 years, which we are very proud of. This next slide shows the individual companies that were our top and bottom contributors for the 1-year, 3-year, and 5-year time periods. A couple things I'd point out. First, over the shorter 1-year period, there's a wide dispersion of individual stock price performance, with our largest percentage gainer in Meta up 194%, and our largest percentage loser in Pfizer down 41%. As we often say, a company's stock price is much more volatile than its underlying intrinsic value. In the short term, stock prices can move around wildly. Second, when looking at the bottom contributors over the longer 3- and 5-year time periods, 3 companies are in both tables: Disney, Pfizer, and US Bancorp. Over the last 5 years, the total return from these 3 stocks is roughly flat, while the market has compounded over 15% annually. So they were big drags on relative portfolio performance. We constantly evaluate every portfolio holding against our 3 criteria: business, management, and price. If a holding still meets our criteria, we will remain very patient and continue to own the company. Finally, when looking at the top contributors, under all 3 time periods, Microsoft, Apple, and Alphabet are 3 of the top 5 performers. This just shows the amazing growth of the tech industry and these 3 tech leaders over the past decade. We would have had a much tougher time outperforming the index over those years without these 3 terrific companies in the portfolio. To give you an idea of our long-term owner approach, let's look at the 5 top contributing holdings on the bottom left of this slide. We have owned Apple for 11 years, Microsoft for 18 years, Progressive for 17 years, Home Depot for 22 years, and Alphabet for 9 years. Moving on, this slide shows our recent portfolio changes. We made a few small adjustments to the portfolio in 2023, but overall portfolio activity remained muted, especially when compared to the frenetic activity across much of the rest of the investment industry. Here, I would once again emphasize that we are long-term business owners, not stock traders. We are trying to identify wonderful businesses with competitive advantages that are run by talented CEOs. We aim to be patient and only purchase these businesses at a discount to our estimate of the company's intrinsic value. However, once we own a company that meets these criteria, we do our best to avoid interrupting the magic of long-term compounding by owning it for as long as possible, often multiple decades. One added benefit of this approach is that the low level of trading activity results in an extremely tax-efficient result for the client. Now, 3 quick points on portfolio composition. First, our sector allocations on the left are intentionally very different from the S&P 500. We believe that outperforming the S&P can only be achieved by looking different than the S&P. Second, we build our portfolio from the bottom up on a company-by-company basis, meaning our sector weightings simply reflect where we're finding investment ideas that meet our criteria, not any sort of top-down macro views. And third, the characteristics table on the right reflects a portfolio that is filled with high-quality companies. Valuation metrics are less expensive than the index, the dividend growth far exceeds that of the index, and the risk statistics are attractive. Finally, just a few big picture comments. We recently came across this quote from Morgan Housel and felt that it perfectly encapsulates not only 2023, but also much of the past 5 years. Entering the year, pessimism was rampant. The S&P 500 was coming off an 18% decline in 2022. The Federal Reserve was aggressively increasing interest rates to combat inflation, and it seemed almost certain that the economy would tip into recession during the year. Yet, to the surprise of many, the economy was resilient and the stock market was much stronger than expected. The experience of 2023, where most prognostications were incorrect, should serve as another small addition to the mountain of evidence that the future is nearly impossible to predict. In fact, much of the past 5 years underscores this point. So we're approaching 2024 with the same mindset we always have. We don't know what's in store for this year, but we know it will contain surprises. For this reason, we don't make predictions about the market or the economy, and especially not about political elections. We don't believe predictions like these are the foundation of long-term investment success. Instead, we focus on owning a portfolio of great businesses with great leaders at reasonable prices. We found that over time that, on average, this is the best way to prepare for whatever future surprises are in store. So that does it for our annual portfolio recap. Thanks so much for your time.